This week on the Retirement Quick Tips podcast, I'm talking about navigating the storm, strategies for weathering a stock market downturn. Now, despite big drops in the markets earlier this month, the stock market, as I record this episode, is actually hitting all-time highs. So it appears as if we've sidestepped a broader crisis for now. But for many investors who saw their portfolio drop several percentage points in just a few short days, it really should be a wake-up call. The markets are vulnerable. They always are. There are inevitable economic cycles of expansion and recession. And typically in a recession, you're going to see the stock market drop anywhere from 15% in a more mild recession, all the way to 50%, which is what we saw in the worst of the worst during the financial crisis and also during the big tech bubble burst in the early 2000s as well. So it's very important to take a good look at how you're positioned right now. Do you have too much in stocks? That tilt towards stocks has benefited you tremendously if you've stayed invested for the last 5 to 10 years. However, if you're close to retirement, like 2-3 years out, and you still have 70% or more in stocks, you probably have too much in stocks. I'm speaking in general terms now, but that should sort of guide you. And if you're 65 and you're planning to retire next year or later this year, and you have 75% in stocks, why is that? Is that necessary? Because I can tell you, if you just do the math, run a stress test on your portfolio, how it currently is, and you tell me if you're comfortable losing a third of the value of your portfolio over the course of 18 months. Could you sustain that same drop if you were retired? Now, when you're working, it's different. You certainly feel those drops, but you know in the forefront of your mind, you're like, I have several years to work. But that all changes as you get closer to retirement, because now not only is it harder to make up for those losses because you're not contributing anymore, but you're making the problem actually worse because in a downturn, you're still going to be taking withdrawals. So you're exacerbating the losses there. So it's very important as you get close to making that transition into retirement that you do not have too much in stocks. So I want this volatility, let it be a wake-up call for you. Go back. If you have too much in stocks, make sure your portfolio is properly insulated, that you have the right balance of stocks, bonds, and cash that is appropriate for you. Now, there's no one right way, no one right percentage. It's based on a variety of factors, but it should be appropriate for you at your age and stage of life and income needs, both now and in the future from your portfolio and just your overarching goals. So that's a whole cocktail that determines what the right allocation should be for you. But we don't want to get caught on our heels in having way too much in stocks and then seeing a big decline that is just devastating. The other thing is not just having too much in stocks in general, but most investors right now have way too much concentration. They think they're diversified because they own the S&P 500 or they own like a target date fund or something like that. But these quote unquote broad diversified index funds have a huge percentage in the biggest tech names. You probably have heard them. I've talked about on the podcast. It referred to them often in the media as the Magnificent Seven. They're the largest tech names. And we've seen clearly that these areas are also the most vulnerable to some of the bigger declines, which is not surprising because they're the areas that have got out over their skis the most. So make sure your portfolio isn't over concentrated, that you are invested. If you're in stocks, we want to be broadly invested in stocks. So you want to look at that at the sector or industry level, but also at the individual stock level as well. So now is the time to be assessing this, making changes. If you wait until a big downturn to get your portfolio in line, I'm sorry, but it is just too late. You have to do it now, and you have to do it while you still have meaningful gains for the year. Most people are sitting on a nice, healthy gain for the year. So we want to take advantage of that, rebalance and reposition now. Last thing I'll say about this is that if you want to stress test your portfolio, see the concentrations of your portfolio, see how much you actually have in stocks, but even beyond that, like how much do you have in the biggest handful of tech names? I can do a portfolio analysis. It's an under the hood portfolio analysis. And if you email me, ashley.m@truenorthra.com, I can send you instructions on what I would need. I basically need to see what your portfolio looks like, what holdings you have in order to do this analysis. So if you email me, ashleyM@truenorthra.com. I will send you the information that I need in order to do this for you for free, 100% free, no strings attached. It's eye-opening for many, and it pinpoints areas that might be of risk as we enter a very uncertain time and have been for quite a while, and uncertain, uncharted waters for markets. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.